All right, welcome back. This is Module 8. In this module, we're going to be talking about why real estate and fixing and flipping are the ideal investment. And obviously, as you can tell from the little periods that separate the ideal letters there, that is an acronym. And we're going to discuss that acronym and why it's important in this section. So stay tuned for that. But like we do in every module, I have to give you a disclaimer before we continue. And that disclaimer and disclosure is that I am not a licensed attorney, accountant, financial advisor, broker, or any other licensed individual. I'm just a student just like you, and I've got some amazing systems that have built some awesome wealth for me that I'm very happy with. I want to share those systems with you, and that's what we're doing right now. So let's dive in. Real estate is the ideal investment. Well, ideal is an acronym, and that acronym stands for income, deductions, equity, appreciation, and leverage. Now, by income, that could be cash flow in the case of a rental. It can also be profit. But how we get to that profit in a fix and flip actually has to deal more with appreciation than anything else. Now, there's two types of appreciation. There's natural appreciation, and that's the type of appreciation you get on a property when you hold it long term. You could buy a property today for $100,000, and you could wait 10 years hypothetically, and sell that property 10 years from now. And because real estate markets tend to go up in value, you could sell that property 10 years from now for 200 grand, right? So you make 100 grand because of natural appreciation. Natural appreciation is just the appreciation that happens over time naturally because of the way that the real estate market behaves. However, forced appreciation is when you take a property and you fix it up. You put nicer stuff into it. You make it current. You make it beautiful. And there's certain ways to do that. And that immediately forces appreciation in the property. That's exactly what we do with fixing and flipping. We buy a property that's a dump and we fix it up and we make it beautiful. That's forced appreciation. That means we could buy a property today for $100,000 and we can put, $40,000, $50,000 into it, fix it up, make it beautiful, and sell it 6 months from now for $200,000 because we forced appreciation. So forced appreciation is achieved by adding value to the existing property to increase the short-term value. Forced appreciation is the main money-making focus for fix and flip projects. And because of this, you have to make sure that the comps you are using to calculate your after repair value are only recently remodeled properties. You don't want to convolute your after repair value by putting properties in there into your comps that aren't remodeled. That will lower your expectations for your ARV, and it will give you an inaccurate ARV on the low end, which will cause you to not do a deal if you're following the system right, except for that part. It will cause you to not do a deal that probably would have been a deal you should have done. So you don't want to make that mistake either. The comps that you pull for your ARV should only be recently sold properties that have been recently remodeled. Okay? There are 5 areas of focus when talking about a single family residential property that will force appreciation. So in the next module, we're going to talk about those 5 areas, what they are, why we spend money on those 5 areas, and anything outside, with very few exceptions, anything outside of those 5 areas, we try not to spend money on. So in the next module, and the reason I separated these modules is because we're going to go into a little more detail in the next module, we're going to talk about the 5 things. So that will be in Module 9. This concludes Module 8. I will see you guys in Module 9.